Welcome back to MonsterInvest. I'm your host, Daniel. Have you ever found yourself awake at 2 a.m., the blue light of your phone illuminating a worried expression on your face, staring at a stock chart? Your finger hovers over the buy button, but you can't bring yourself to tap it. Sweat forms on your brow, paralyzed by a single, terrifying question that has haunted investors for centuries. Is this the right time? You switch apps to check the news. It's chaos. One headline screams that the market is on the verge of a super cycle that will mint new millionaires overnight. You feel a rush of adrenaline. But then you scroll down just an inch, and the next headline warns of a catastrophic recession that will wipe out savings and reset the economy to the Stone Age. You freeze. The adrenaline turns into nausea. You decide to wait. You tell yourself, I'm smart, I'll just wait for the dip. A week goes by and the market ticks up by 2%. You feel a pang of regret. You tell yourself, it's a bull trap. It'll come back down. It goes up another 3%. Now you're angry. Finally, after months of watching from the sidelines, you can't take the psychological pressure anymore. You convince yourself that this time is different, and you buy in at the absolute peak. And almost like clockwork, the next day, the market crashes. If that scenario makes your stomach churn with familiarity, you are not alone. That is the emotional roller coaster of trying to time the market. It is a high-stakes game of poker played against millions of other investors, algorithmic trading bots, and global economic forces you cannot control. And frankly, it is a game that almost everyone loses. But what if I told you there is a strategy that allows you to completely ignore the news? A strategy that doesn't care if the market is bullish, bearish, or moving sideways. A strategy that actually turns market volatility, the very thing that keeps you up at night, from your worst enemy into your best friend. Today we are going deep into the most powerful, yet arguably the most boring tool in an investor's arsenal, dollar cost averaging, or DCA. Now before you roll your eyes and say, Daniel, I know what DCA is, it's basic stuff, stick with me. Because there is a massive difference between knowing the textbook definition of DCA and truly understanding the behavioral superpower it gives you. We are going to explore why this simple strategy beats the smartest minds on Wall Street. At its core, dollar cost averaging is the practice of investing a fixed dollar amount into a specific investment at regular intervals. That's it. It doesn't matter if the price is at an all-time high. It doesn't matter what the Federal Reserve chairman said at lunch. It doesn't matter if your neighbor thinks crypto is the future or a scam. You invest the same amount, every single time. But to really understand why this works, we need to move beyond theory. I want to tell you a story of two imaginary investors. Let's call them Robert and Emily. Robert is what I call the sniper. Robert considers himself a sophisticated investor. He loves data. He subscribes to 3 different financial newsletters. He wakes up at 5 a.m. to check the Asian markets and tracks the price of copper because he thinks it signals global demand. Robert has $10,000 ready to invest in a popular tech ETF, but Robert is a perfectionist. He refuses to overpay. He wants to buy at the absolute bottom to maximize his gains. So let's look at his year. In January, the ETF price is $50. Robert says, the PE ratio is too high. I'll wait for a pullback. In February, the market gets shaky and the price drops to $45. Robert gets excited. He feels like a genius, but then he thinks if it dropped $5, it could drop another $5. I'll wait for 40. In March, the market unexpectedly rallies. The price shoots back up to 55. Robert panics. He thinks, I missed the bottom. I can't buy now. I'd be overpaying. This cycle of hesitation continues for months. Robert is holding cash, and while he feels safe, he is actually losing money every day to inflation. His cash is sitting there doing nothing, while companies are growing, dividends are paying out, and the economy is expanding. By June, the price has climbed to $65. Robert is frustrated. He's actually angry. He feels like he's losing money by not being in the market. The news is now overwhelmingly positive. Everyone is making money except him. Finally, in a moment of pure FOMO, fear of missing out, he capitulates. He dumps his entire $10,000 in at $65 a share. Now let's look at Emily. Emily is the farmer. Emily has a demanding job. She's training for a marathon, and she frankly finds stock charts incredibly boring. She also has $10,000 to invest this year, but instead of trying to be a sniper, she sets up a boring automatic transfer. She decides to invest roughly $1,000 on the first day of every month, regardless of what the world looks like. In January, she buys at $50. In February, when the price drops to $45, remember Robert, he was waiting for it to go lower. Emily just bought, and here is the crucial math. Because the price was lower, her $1,000 bought more shares than it did in January. In March, when the price went up to $55, her $1,000 bought fewer shares. This went on for 10 months. Sometimes she bought at the peak, sometimes she bought in the valley. She didn't check the news, she didn't know the PE ratio, she just let the system run. Here is the magic of this story. By the end of the year, let's say the market settles at $60. Robert, our sniper who tried to time the market and bought in at 65, is currently underwater. He is down nearly 8% on his investment because he bought at the peak of emotion. He is stressed and he feels like a failure. Emily, however, bought shares at 45, 50, 55, and 60. Because she bought more shares when the price was low and fewer when it was high, her average cost per share is significantly lower, likely around $52 or $53. Even though the current price is 60, she is sitting on a healthy profit. Why did Emily win? Because she utilized the mathematical advantage of the harmonic mean. Her money worked harder for her when the market was down. She accumulated volume when the asset was on sale. But there is another layer to this, the opportunity cost of missing out. You see, market returns are not evenly distributed. Most of the market's gains happen on just a handful of days each year. If Robert tries to time the market and misses just the 10 best trading days of the decade, his returns could be cut in half. By being out of the market, waiting for the perfect entry, Robert runs the risk of missing the very rally he is hoping to catch. DCA ensures Emily never misses those best days because she is always buying. This brings us to the psychological aspect, which is arguably more important than the math. DCA removes the single biggest risk to your wealth, you. Human beings are terrible at emotional regulation when money is involved. We are biologically wired to be greedy when stocks are high, following the herd, and terrified when stocks are low, fleeing danger. That is the exact opposite of the golden rule: buy low, sell high. Think of it like shopping at the grocery store. If you walk in and see your favorite premium steaks are on sale for 50% off, do you run out of the store screaming in panic? Do you say, "Oh no, the value of steak is crashing"? No, you fill your cart, you call your friends, you buy as much as you can fit in your freezer. But in the stock market, when prices drop 50%, people treat it like a burning building. They run away, they sell. DCA forces you to treat stocks like steaks. It forces you to buy that steak when it's on sale, automatically, without your fear brain getting in the way. But there is another benefit here, one that isn't on a spreadsheet. It is the sleep factor. Let's go back to Robert. Robert is stressed. He's checking his phone at dinner. He's worried about the next crash. Every red day feels like a personal attack. Emily, she's sleeping like a baby. She knows that if the market crashes tomorrow, her automatic transfer next month is just going to buy more shares at a cheaper price. She actually starts to see red days as opportunities, not disasters. She has detached her emotional well-being from the daily fluctuations of the S&P 500. Now I have to be balanced here. Is DCA perfect? No strategy is perfect. There is a legitimate mathematical argument that says if the market goes up in a straight line forever, putting all your money in at once, lump sum investing wins. This is because markets generally trend upward over long periods. By holding cash on the sidelines to drip feed into the market, you might experience cash drag, where that uninvested money isn't earning a return. But let me ask you this: how often do markets go up in a straight line? Almost never. They are volatile, they are messy, they have corrections, crashes, and bear markets. And more importantly, do you have the stomach for lump sum investing? If you put your life savings in today, and the market drops 20% tomorrow, will you panic and sell? If the answer is yes, then the mathematical advantage of lump sum investing doesn't matter, because you would have blown up your account due to psychology. DCA is the insurance policy against your own bad behavior. It ensures that you are never all in at the absolute top, and you are never all out when the market takes off without you. Also, a quick warning: DCA is a strategy for how to buy, not what to buy. Dollar cost averaging into a company that is going bankrupt just means you are efficiently losing all your money. This strategy works best with diversified assets like index funds or blue chip companies that have a long-term upward trajectory. DCA is a multiplier of your investment thesis. If the thesis is good, DCA makes it great. If the thesis is bad, DCA makes it a disaster. So before we wrap up this episode, let's summarize what we have learned today so you can take action. First, market timing is a trap. It creates paralysis of analysis. Trying to guess the perfect entry point usually leads to hesitation, missing the best trading days, and eventually buying at the top due to FOMO. Second, DCA lowers your average cost. By investing a fixed amount regularly, you mathematically buy more shares when prices are low and fewer shares when prices are high. This smooths out the volatility and can lower your break-even point. Third, it automates discipline. DCA removes emotion from the equation. It stops you from panic selling in a crash and panic buying in a bubble. It turns investing from a stressful decision-making process into a simple monthly habit. And finally, the peace of mind factor. The best investment strategy isn't necessarily the one with the highest theoretical return on a spreadsheet. It's the one you can stick with for decades without losing your mind. So if you've been sitting on cash, waiting for the stars to align, waiting for the perfect moment, consider this your sign. The perfect moment was yesterday. The second best moment is right now. Set up that automatic transfer, turn off the news, delete the trading app from your phone, and let time do the heavy lifting. That is it for today's episode of Monster Invest. If you found value in this episode, please do me a huge favor, hit that like button. It helps the algorithm know that we are sharing good advice. And if you know a friend who is stressed out about the market, share this episode with them. It might just save their portfolio. And most importantly, if you haven't already, make sure to subscribe and hit the notification bell. We have a deep dive coming up on the psychology of money that you absolutely do not want to miss. I'm Daniel, reminding you that the market is a monster, but you can tame it. Thanks for listening, and I'll see you in the next one.